OPEC has met and taken a decision on August output. The oil cartel did not go in the direction many were hoping. With a tight market and production issues, what happens next? We'll also look at the inflation situation in Nigeria. Global ratings agency Fitch says that the country's rising inflation is dampening the economic growth and eroding consumer purchasing power. This is Business Edge. I'm Tolulope Adeleru-Balogun. Let's get started with African business headlines. South Africa's Eastern Cape economy, particularly the province's automotive and agricultural sectors, are set to receive a significant export boost from the 9.1 billion rand infrastructure development investment by Transnet National Ports Authority. The investment, over a 7-year period, comprises a budget allocation of 4.8 billion rand for the port in Port Elizabeth and one other, as well as 4.3 billion rand for the East London port. And staying in South Africa, this week's load shedding, with today marking the 4th straight day of stage 6 rolling blackouts, is hitting the economy hard. While the actual economic impact is yet to be calculated, economists and business leaders are already warning that the toll will run into billions of rand and will have other ramifications such as lost investment, a negative impact on the country's already sub-investment grade credit rating, and deteriorating businesses, as well as consumer confidence levels. The last time South Africa had stage 6 load shedding was on the 9th of December 2019, and it lasted for less than a day. The Kenyan government has set a deadline of August 6 for anyone interested in importing maize, while the recently announced tax waivers are still in effect. The tax exemptions on imported maize, according to Agriculture Cabinet Secretary Peter Munya, would ensure that there is significant maize supply in the nation, reducing the cost of flour manufacturing. According to some of the rules importers must follow, maize cannot be genetically modified in accordance with Kenyan laws and regulations that are put in place by the National Biosafety Authority and the Kenya Bureau of Standards. Until the outcome of an appeal to the Supreme Court over an oil spill in 2019, Shell has postponed plans to sell its onshore oil assets in Nigeria. In a statement, the company said, "We applaud the decision of the Nigerian Supreme Court to hear the SPDC's appeal in this matter. We won't move forward with the divestiture until the conclusion of the process." On June 16th, the Nigerian Supreme Court affirmed a lower court order that barred the London-based corporation from selling its assets until a dispute over the lower court's award of $1.95 billion in compensation to Niger Delta communities for the leak is settled. South Sudan is posing a fresh threat to Kenya's port of Mombasa, sparking renewed calls for trade to switch via the Djibouti route. If this happens, Kenya will lose out on money from the 1.1 million tons of cargo that the port handles each year. For all shipments going to the landlocked nation, Mombasa has always been the primary route. Nevertheless, South Sudan currently claims that the port of Djibouti is shorter. Sudan is currently in talks with the government of Djibouti so it can connect Djibouti, Ethiopia, and South Sudan to access the port through Ethiopia. The crude oil markets will continue to be a tight one as OPEC and non-OPEC partners, referred to as OPEC Plus, have decided to stay the course with their production policy. This means monthly overall production for the month of August will increase just slightly. And of course, Nigeria's inflation conversation, all of that's right after this. Now, Fitch Ratings says efforts to reduce inflation in Africa's largest economy will be hampered by Nigeria's unconventional monetary policy strategy. In a report released on Thursday, Fitch said that the Central Bank of Nigeria's decision to increase its benchmark interest rate by 150 basis points to 13% in May for the first time in over 6 years does not represent a fundamental change in its unorthodox strategy. It increased its inflation projection for the year from 14.6% to 17% and said it expects Nigeria's complex policy approach to be maintained at least until the next presidential election in February 2023. Joining me from Lagos, Nigeria is Gospel Obele. He's the chief economist for Streetnomics. Gospel, welcome again to Business Edge.
Hi, Tolu. Thank you for having me.
So let's start with looking at what Fitch has said overall. Right now, we have an inflation rate that hovers around 17.7%, I beg your pardon. And we have the CBN raising the benchmark interest rate to 13%. A general rule of thumb is that both inflation and interest rate should be close together, or that the interest rate should be slightly higher. What's really going on in Nigeria?
Yeah, I mean, the rule of thumb only happens when all things being equal. There is always that line of assumption that's being made anytime an economic theory or a model is being quoted. All things being equal, X, Y, Z is a function of this and that, or this and this should go, in accordance. That inflation and interest rates should rise together, or it should be within the same reasonable window. But then again, it's also very important to note that this inflation interest rate dynamics is a global conversation. It's not just a Nigerian conversation. But before I get into that, it's also for me to state, first of all, that structurally in Nigeria, the way our economy has evolved and how our economy is currently being managed and what the outcomes we currently see defies the rule of economics. That's the rule of thumb. But also, to the major point I'm trying to make is that the conversation around interest rate and inflation is a global conversation right now. We've seen the Fed increase interest rates recently, and with concerns that they're going to increase it almost to about at least 5 to 10 more times before 2024. And in the UK, you also saw the same thing, that interest rates are almost a 40-year high and all of that. So it's a global conversation to start with. But having established that is the fact that I think globally, be it in the US or even, we need to look beyond just the economic rule of thumbs. And this is why I say so. The conversation around interest rates now globally and inflation is such that inflation is driven across, how I put it, the fundamentals of what is driving inflation right now are core structural problems happening globally than monetary challenges. So you look at the Russian-Ukraine war, commodity prices have increased because supply chains are disrupted, right? Grain, maize, sunflower, soya bean, and key commodities that are required for global food production and consumption are currently being disrupted due to the war. Secondly, China is a bit contracting. China and Vietnam are slightly contracting because of new cases of coronavirus and recent lockdowns and all that. So these are evolving conversations globally that are informing commodity prices and penetrating through manufacturing and production dynamics, right, to increase prices of goods and services in the market, which you want to talk about inflation. But then again, from history, the instrument of interest rates are used to discourage borrowing. All right. So it's believed that when inflation is rising, you increase interest rates so that it becomes difficult for people to borrow. The assumption is once it becomes difficult for people to borrow, then it means that the money circulation will be reduced or to be slowed down. And with that, inflation will drop because it's looked at from the angle of increased money in circulation. But right now, the world has evolved. The dynamics of the global environment, just the way global pandemic led to a global recession. All right, the dynamics of the global economy or global environment is now being impacted on other legs outside the monetary core, all right, outside the core of monetary economics. So what I'm arriving at is that we cannot keep using a monetary instrument as a standalone to control an inflation or to control inflation that's being powered by deeper geopolitics conversation, deeper public health conversation, deeper structural and cost push conversation for economies like Nigeria and all of that. So there is a stronger mix of reinforcement at the structural level than just monetary.
So when you look at that stronger mix, as you pointed out, does it then make sense to go ahead and raise this interest rate? As you said, the idea behind raising it is usually to slow down excessive borrowing. But at a point in time where you have a world that was coming out of COVID-19, you already had those issues on ground, the structural ones, the core ones outside of Nigeria's context as we look at. Is it in our best interest right now to raise the interest rate?
So that's the challenge we have. Globally, economists and economics/finance managers haven't evolved in terms of contemporary thinking when you look at economics as a discipline. The reason why I say so is because the first response by finance and monetary and economic managers would be to use a monetary instrument, all right, to control inflation. And that's what will keep happening actually, because I mean it's like a training capacity. That means you know something so much, you know how a thing works so much that you are not open to newer ways to rethinking the problem or newer ways to fixing that problem. All right. So the first disposition, and which is actually going to happen, is interest rates. And so technically, governments globally and monetary economic leaders like CBN governor, Feds and the likes are firefighting because you're trying to use interest rates and all that. So I do not actually expect them to do something different, because these are people who are set in their ways and these are economic theories are already set. But then again, there is need for them to evolve, to look at the world differently, just the way that we had to look at the world differently in terms of how a global pandemic led to a global recession.
Yes.
All right, 50 years ago, 25 years ago, that wouldn't have been the case. It has to be an economic related variable, all right, that leads to an economic recession or a global recession. But now the game is changing. So my encouragement would be to begin to, intensify the shocks from the Russia-Ukraine war. Structural balancing has to come into place. Stimulus and support programs have to come into place if inflation will reduce. Otherwise, they will keep increasing interest rates and inflation will keep worsening.
All right. So let's also look at something else that Fitch said. And it was earlier this year, or rather for the first quarter of the year, that Fitch rated Nigeria's economic outlook at B- for the first quarter. And they've described the CBN's monetary policy as unorthodox and complex. And there are a lot of people who have said that Nigeria needs to look for new ways to do things. The old ways, the rule of thumbs are not working in the Nigerian context. So you would think that an unorthodox approach may work, but that doesn't seem to be the case in this situation. Fitch also says that the unorthodox approach will likely impede efforts to curb inflation. Do you think they're right? And would you call the approaches that Nigeria has taken to this issue as being unorthodox and overly complex?
Well, I would say on two grounds. Number one, Fitch has a very valid argument. I mean, I've always said that before, that the current model and process through which our economic managers are thinking of the Nigerian economy is really flawed, from the design perspective. Yes, and it could be unorthodox because you're trying to use conventional wisdom to deal with a very, very deep structural problem. And yes, relatively complex as well, because you also see the CBN trying to get into areas where it shouldn't get to. There's also some form of trying to cover up for the long history of fiscal discipline as well. All right, so the central bank is getting into funding mechanisms, rolling out its own policies that are a bit contradictory and hurting the growth and development of the financial system in its entirety. You can look at that from the past BDC conversation, from the FX policies, from the crypto policies, and all of these things. It's been, even the e-naira, it's been firefighting, and it has not been coherent and cohesive and all that. So yet on those grounds, you agree that yes, the central bank has to look at the problem differently and learn to deal with the problem differently, particularly in complementary engagements with the fiscal policy. But however, the other part of the Fitch argument is that this is not a Nigerian problem only. It's just that for Nigerian, it's a worse case to deal. It's a more complicated place to deal, all right? But it's also a global problem. Right, globally, there is some form of conventional wisdom in seeking to deal with the problem, because right now there are fears of a looming global recession if inflation is not brought down, at least to half what it is right now in different countries. All right, so the EU, for instance, expected inflation would be at 2%, or try to make sure that they retain inflation at 2%. But right now, those numbers are skyrocketing to very close double digits and all of that. And I'm saying this because by the next 1 month now, it's going to be an evolving conversation,
yes,
and we may have hit double digit globally. So there is need to just, in its entirety, think of newer ways to do things. Yeah.
All right, so we'll continue with the global context of that, because we also do know that the chairman of the U.S. Federal Reserve said that America should be looking at more increases in the interest rates, and that also might be the direction that the CBN also has to go. But this conversation will pick up from the break when we look at that, and also what does Nigeria need to do? If we've made mistakes, where now should the progress and direction be? Stick around. My guest today is Gospel Obele. He's the chief economist for Streetnomics in Lagos, Nigeria. And the conversation is looking at the potential of Nigeria increasing interest rates to combat rising inflation. Now, we know around the world, as Gospel has said, this has been a reoccurring conversation and is one that is going to continue to evolve as the world continues to see the shock waves coming around and the global economy is actually shaking. Now, a member of the CBN's Monetary Policy Committee has come out to say that the inflation is likely to get worse, except the Apex Bank aggressively hikes interest rates. That it is not a one-time raise that will be enough. So, Gospel, do you anticipate Nigeria getting some more interest rate hikes? As you said, of course, the Federal Reserve, Jerome Powell, is looking at more interest rate hikes in the next few months before we get into 2024. Do you think Nigeria is going to follow course as well? And can the economy take it?
It's very likely. It is also very likely because the CBN is actually in a fix, and we've rolled out a lot of reactionary-driven policies. And the problem with reactionary-driven policies is that you get to a point where there's a fix, and you've caused so much damage in the structure of the economy that it's going to cost you more, to rework properly, in terms of scaling sustainably and all that. So the default mode is to keep increasing interest rates, and the argument for them, right? I'm not saying that's the right thing to do. For them, the default mode would be to keep increasing interest rates, and they will try to make a case around it, knowing also fully well that major central banks in the world are equally doing the same. On the other side of things as well, I mean, if they choose to go on the counter, the central bank needs to be ready and willing to make clear its position to do that, especially if it's being confronted at the global stage of conversations, because when it comes to bonds, investment, and all of these other major FDI conversations globally, if you're not going in the way others have gone, there's always a conversation and a risk as well, especially if you're a vulnerable economy needing help. All right, so Nigeria needs to, wake up and try to do what's most important and most relevant for its own economy. Although I don't see that happening. And then if it happens that way, of course, the shocks will be a bit more severe. Not a bit more severe, to be severe as we go on, knowing also that pre-elections and all of those things will intensify uncertainties as well. That also comes with its own cost push impact, on inflation. And that's a Nigerian conversation that we need to have as well. So all of these different metrics are on the table. And I don't expect inflation to go down anytime soon, because they are critical enablers for it. Yeah.
And we'll get into what the fundamentals that Fitch may be expecting. But before then, there was one other thing that the report highlighted that I found quite interesting. And it said that the CBN's inflation fighting efforts were complicated further by the fact that the CBN lends to the federal government. Now, IMF figures show that the CBN's net claims on the federal government rose by roughly 23% year on year in January of this year. And CBN officials have suggested that raising policy interest rates could moderate government domestic borrowing. However, the interbank treasury bills true yield remains low at about 3.9% for 3-month bills at the end of the month. But can the CBN really stop lending to the government? How much of a problem is that's affecting this fight against inflation?
So like I was saying just now, that a lot of the reactionary driven policy by the central bank has also cost us what we're dealing with right now. And part of which is also that the central bank has gone into a lending spree, with the federal government. In many cases, even many bailout conversations, both those we know of and those we're not even aware about. And the central bank bails out a lot of Nigerian estates that are not commercially viable. So those monies are locked and are lost in the scheme of things already. And, it just finds, those leakages just find a way to plow back into the economy on the cost side of things, not on the investment or returns or productivity side, unfortunately. So I think in one other case, the central bank is also part of the whole process. And I don't see that happening anytime soon, because of the structure of what's happening. In fact, there are some civil servants that have not been paid for the past 2-3 months. And we've had a lot of party primaries and all of that. So that's another conversation to deal with.
So when Fitch says it's an unorthodox and a complex situation, also pointing out that Nigeria should actually be getting some higher oil revenue receipts because of the higher oil prices, what do you think Fitch is expecting? Maybe not just Fitch. There'd be a lot of people expecting something different or something significant from the monetary policy and the fiscal side of things here in Nigeria.
I mean, it's understandable if a lot of stakeholders expect a lot of things. Nigeria holds a lot of promise, and there is no reason why the nation shouldn't be working. Although there are a lot of complexities to its growth and productivity dynamics as well. But then again, some of the things that the pitch has also said is a bit looks like plus and minus conversation, give and take, a garbage in, garbage out, but it doesn't work like that in Nigeria. So, for instance, you expect Nigeria to be making more from the increase or improvement in the oil price and all that recently, but we realize that it's almost going south. And that's because there is a blockade somewhere in the middle. And that's the fact that foreign exchange is worsening and we need to import almost 80% of the fuel we use in the country. That means that you're spending more, so when you do the cost and the revenue, the dynamics and all that, you're either almost at a loss or not earning anything significantly. And also note that in the last 3 months where oil price has increased was also the same time there's a lot of forecasting in Nigeria. NNPC has raised voices to say that we do not have enough money to continue with the subsidy. There have been fierce perceptions, to take off, in quotes, the subsidy and all that. So the truth is that conversation is very complex. And because we are not a sole producer, a sole refiner, if we were and we're exporting, then would have benefited more from the increase in global oil price because we are only earning revenues and we are not buying back. But now we're spending a lot more around, worsening FX rates to, import a significant chunk of the PMS or your fuel and all that's being used locally. So it's okay to have expectations, but then again, we need to go back to the drawing board because for Nigeria, it's both being at the receiving end of global shocks, that's the Russia-Ukraine war, the commodities pricing and all that, being a strong import-led economy, plus the fact that our currency is worsening, we do not have enough access to exports and all of that. So once we begin to rework on the flip side, all of these dynamics will be at a much more safer place to compete globally and, begin to manage the impact of global events on our local economy as well.
All right, so let me just ask this, and I need a yes or no very quickly. Should Nigeria, as well as the continent and even the rest of the world, be preparing for another global recession?
It makes sense to prepare, yes.
Wanted to be diplomatic and political with the answer, but Gospel Obele, thank you. All right, thank you. We'll probably have that conversation sometime soon.
Yeah, looking forward to it.
All right. And Fitch is forecasting Nigeria's growth at 3.1% in 2022, expecting high oil prices to lift oil receipts. But of course, we know there are issues around that. And together with a post-pandemic recovery in activity, it should, the operative word being should, support non-oil sector growth. Still, high inflation this year will dampen growth by eroding consumer and business purchasing power. You're watching Business Edge. That was our first conversation looking at the rising interest rates in Nigeria and how that could combat the rising inflation. When we come back from this break, let's get into OPEC Plus and their decision to stick with the production policy for August.